Just when we thought things were starting to calm down, a new shock has just hit the world stage. It's being called the 2026 oil shock, and its effects are already rippling across the globe. So today, we're going to break down exactly what's happening and what it means for all of us. All right, so what kicked this whole thing off? Well, it all starts with a new conflict erupting in the Middle East. And even though the fighting itself is regional, the economic fallout, that's become a global problem, starting with a huge hit to our energy supply. And the impact was, well, immediate and pretty dramatic. We're talking about a tidal wave hitting the markets. Oil prices just skyrocketed by a staggering 84%. And for Europe, which was already in a tough spot, natural gas prices basically doubled, jumping 98%. These are the kinds of numbers that make everybody, from top bankers to regular families, sit up and pay attention. So how in the world did this happen so fast? It was kind of like a set of dominoes falling. First, the conflict begins. That leads directly to a major disruption in a critical shipping lane, the Strait of Hormuz. And that one disruption was enough to trigger this massive global surge in energy prices. It's a textbook case of how geopolitics can hit you in the wallet almost overnight. And this right here shows you why that one tiny spot on the map is so incredibly important. Think about it. 1/5 of the entire world's oil and 1/5 of its natural gas has to squeeze through this one narrow channel. It's the definition of a choke point, and it really highlights just how fragile our global energy system can be. Okay, so a conflict halfway around the world makes energy prices soar. But how does that actually translate into you paying more for, well, everything? To get a handle on that, we're going to look at the Eurozone, because they felt the shock almost instantly. The European Central Bank, the ECB, pretty much had to throw their old forecasts in the trash. Their new projection for inflation across the Eurozone for the whole year is now 2.6%. Now, I know that number might not sound huge by itself, but trust me, the context is what makes it so jarring. And here's what's really wild. Just a few months back, in December of 2025, the ECB was thinking inflation would be around 1.9%, right where they want it to be. Now, that forecast is completely out the window, replaced by 2.6%. That is a massive jump, and it's almost all because of this one energy shock. And if you look at the immediate future, the picture gets even more concerning. The ECB is now bracing for a spike that can hit 3.1% in the second quarter. That's not just a little bit over their 2% target, that's a serious overshoot that puts a ton of pressure on the whole economy. But here's the really nasty twist in this story. This isn't just about prices going up. The very same shock that's pushing inflation higher is also slamming the brakes on the economy, pushing growth down. It's a painful 1-2 punch. And you can see the damage right here. Before this all happened, the Eurozone was expected to grow by 1.2%. The new forecast, that's been slashed to just 0.9%. Now, that might not sound like a huge difference, but that drop represents billions in lost economic activity. And the reasons for this are pretty simple, but they're brutal. Higher energy prices act like a tax on everyone. They just suck money out of people's pockets. That, in turn, makes everyone nervous, so both regular people and big companies get scared and stop spending and investing. The whole economy just slows down. So you've got this really toxic combination. Prices are rising, but at the exact same time, the economy is slowing down or stagnating. There's a word for this. It's called stagflation, and it is the absolute nightmare scenario for anyone trying to manage an economy. This kind of stagflationary pressure puts central banks, like the ECB, in a really, really difficult spot. Why? Because their usual tools are designed to fix one of these problems, but in doing so, they usually make the other one worse. So to understand how they're reacting, we have to talk about their monetary policy stance. I know, it's a fancy term, but all it really means is their game plan, how they plan to use their main tool, interest rates, to try and keep inflation under control without wrecking the economy. And this slide perfectly captures the impossible choice they're facing. Do they raise interest rates to fight inflation, but risk throwing the already weak economy into a full-blown recession? Or do they keep rates where they are to help the economy, but risk letting inflation just spiral completely out of control? It's a true damned if you do, damned if you don't situation. So what's their move? Well, for now, they've decided to wait. They're hitting the pause button. They're keeping interest rates steady, making decisions one meeting at a time based on whatever new data comes in, and they're flat out refusing to promise what they'll do next. It's a strategy of maximum flexibility because they're in a time of maximum uncertainty. And hey, don't just take my word for it. This is a direct quote from the ECB's own report. The Governing Council is not pre-committing to a particular rate path. In the super careful language of central bankers, that's their way of shouting, we have no idea what's coming next, so we're keeping all our options on the table. And this whole wait-and-see thing makes a ton of sense when you look at all the storm clouds gathering on the horizon. The situation is really fragile. And honestly, it could get a lot worse. The ECB is pretty clear about what they're worried about. What if the conflict drags on? That could push energy prices even higher. They're also worried that high inflation could become permanent if it leads to what they call second-round effects. That's a dangerous cycle where workers demand higher wages, which pushes prices up even more. And on top of all that, you have risks to global trade and the chance that markets just panic. So here's their official bottom line. When they say risks to growth are tilted to the downside, that's central bank speak for it's more likely the economy will do worse than we're predicting. And when they say risks to inflation are tilted to the upside, you guessed it. It's more likely prices are going to be even higher than they're forecasting. Not exactly a rosy picture. And all of this leaves us with the one massive question hanging over everything. You've got rising inflation on one side and slowing growth on the other. Governments and central banks are walking a razor's edge, trying to balance the two. The real question is, how long can they stay on that tightrope before they fall one way or the other? The answer to that is probably going to define